Good day, everyone. Well, we are seeing the markets attempt to bounce, or continuation of the bounce since last week. Nevertheless, we continue to also see a serious lack of leadership. Uh, the, the junk stocks basically junk off the bottom. That tends to be what's carrying this rally in the major averages. But if you look at stocks like Facebook or Google, and Apple, of course, a number of these formerly leading names, they have very, very poor bounce characteristics. They're not bouncing with the rest of the market. And instead they're forming wedging type of price volume action, which is a bit of an alarm signal. And the stocks that are actually approaching or reaching new highs are utility stocks, food stocks, other defensive names. In fact, when I'm running my screens, I'm quite surprised at the lack of quality of names that make it through the filters. It's quite unusual to see such a pronouncement of defensive names come through and make it through the filters, and absolutely no other stocks. Certainly, none of the prior leading stocks are making it through the screens because they're just wallowing in this attempt to bounce off their lows, but they're not making much headway. What is also interesting is that oil, the price of oil and stocks have been at, I would say, about a 90% or higher correlation since the start of the year. In fact, if you look at USO, you'll see that on an intraday basis, it correlates lock in step with the major averages like the NASDAQ and or the S&P. So that's quite telling. I think the fact that there's some companies, some institutions that are sending out serious warning signals if the price of oil drops to $25 a barrel, and it almost did. Firms like JP Morgan that are then forced into liquidating their stocks and allocating larger loss loan reserves as a consequence of oil dropping that low. I think all eyes are on the price of oil as a consequence of where it's at right now. Now, it is bouncing. It's back up into the 30s. And the question, I guess, is this a legitimate bounce? Are we going to actually see a real bounce in commodities as well? Where some people have been saying, oil's going to head back up to 40. But that still remains to be seen. I would say that the downtrend is largely intact on commodities and on oil, and also in the major averages. I mean, which topped middle of 2015. I think this, if you look at the NASDAQ peak to trough, it was off 19.5%. S&P peak to trough was off 15.2%, and there's no real evidence that that the markets have put in a definitive low. That means that that we've got blue sky ahead, and that these markets are going to finally start to approach new highs, and then start into these nice uptrends that we saw during the QE markets of 2009 through 2014. Rather, I think there's so much evidence that just in the way that leading stocks are lagging, and also the way the S&P earnings are faltering, and the downtrends are intact. And so I think during volatile periods like the one we're in, it's best, of course, to keep your risks under control. That's why the MDM did go to a neutral signal, because it did hit its failsafe. These failsafes have been more in place, especially during these volatile markets, because for all we know, this uptrend could swing much further than we think, and you don't want to be sitting in on the wrong position, on the wrong side of a nasty volatile swing in the markets. The VVX, the VIX volatility model, on the other hand, is a faster moving model, And so it sensed a possible reversal in today's action. If so, of course, it potentially will hit another one of these 15% days or 15% profits in UVXY, at which point, this has happened a number of times since the model went into beta on the website, and I think it's telling, as we've said every time, it's not a bad idea to take partial profits or all your profits when you have that kind of quick gain in UVXY. Now, if you're trading a 1x like VXX, then that would be half of that, so 7.5%, which still is an incredible gain to have in 1 or 2 days, especially in the type of markets we've been up against. So, nevertheless, the VXX. The VVM rather is on a buy signal, so it's buying volatility, and it's going to keep its stops very tight here as usual. So if it's wrong, it's wrong. It's out, back into cash. The MDM, meanwhile, it's going to be a little longer in sensing a reversal. So it does have its reversal point. If the market does fail here, it's not going to sit in cash. It is going to go back to its sell signal. But the market has to prove itself in more definitive terms before it goes into that position. And in the meantime, it will sit in cash. And as far as the market's just drifting higher like they did in October, November of last year, that's, of course, a big challenge. That can happen, especially with the way markets are manipulated these days. The upside, though, is that the QE's out of the system in terms of the Fed is concerned, and so it seems highly unlikely that we're going to get a repeat of October, November. There's so much has changed between October and November and where we are now with the markets. So unless oil is really going to take off and commodities are going to take off, I think that this bounce is going to be short-lived. And the thing of the matter is that the global economy just gets worse and worse. There's no real evidence that there's any sort of turning point or rescue away from impending recession on a global scale. And markets do correlate, and we've been through these periods before. If you look at 100 years of history, we have had these types of situations where there's contagion. European contagion will cross the Atlantic, and the U.S. will get hit. And I think it's only a matter of time. And with that, I'll turn it over to Gil.
Good morning. Dr. Cass, I'm wondering what your thoughts were on this G20 meeting that's going to occur, I guess, over the weekend tomorrow, and they're going to issue some sort of joint statement. Do you have any expectations for that?
Well, I know that's going to ultimately be quite a disaster for the world, because there's a lot of things that they have planned in motion, such as to digitize currencies, to get away from paper currencies. And that's essentially so that they can track taxes. They can track anyone with money. Governments are dead broke, and they are hunting money. They are hunting money in the form of taxation. And they're disguising it in all these wars on terrorism, et cetera, et cetera. So the G20 meeting, I don't expect good things. I expect a continuation of what's been happening. But one has to read between the lines and forget what they're saying on paper. Forget what they're saying to the press, and forget what the press is reporting. It's more important to look between the lines and seeing what real action is taking place and what are the consequences. And things like the push for the digitization of money is not a good thing, because it allows them to track everybody. There's so much evidence around the world. Again, Google for this stuff. Don't take it from me. Google and do your own due diligence. But continents, countries like Australia, for instance, are targeting their wealthy by tracking students who are going to wealthy schools, because they figure, well, if parents can afford to send them to wealthy schools, they must be making money, and maybe they're hiding taxes. In Geneva, the U.S. has forced them to turn over all the records of warehouse, those who store rare works of art in Geneva warehouses. The Chinese do this because it's a great way to get money out of the country. But consequently, by the U.S. forcing Switzerland to do this, turn over these records, they can go on a money hunt again. And that's what's happened to the world. This is a worldwide phenomenon. This is not just endemic to one country.
Yeah, my thinking is they'll just confirm the general movement towards more stimulus, more QE, and then of course the negative interest rates. And I think that's been the driver behind the move in precious metals. Gold is pulling back today a couple of bucks on the GLD, but I would not be surprised to see it find support somewhere along the 20-day moving average, so keeping an eye on that. And of course that brings the miners into play. I've been watching things like Newmont Mining holding along the 10-day. What's interesting is the miners are holding up better than gold is actually up here. You see they're holding their 10-day line. Gold's coming a little bit, more or less the same. Some of the others I've been watching, Agnico, Silver Wheaton, holding up, but I'd watch some of these for pullbacks. My thinking is I might hold a position either in gold or in a gold miner over the weekend, expecting that they might come out with some sort of dovish commentary about doing everything they can to just keep doing what they're doing, which is basically print money. So that's one thing to keep an eye on. So, and you were talking about oil, and of course the market's been correlated to that recently, and there's a lot of talk about maybe a bottom in oil, with some of these OPEC nations getting together and working out production cuts. But my thinking is if that was really going to happen, if the market really believed that something concrete was going to occur, you would see the price of oil jacking and heading closer towards the 40 level. The USO is priced a little differently, but you figure it's about a third of what it's at now, a little bit less. But I would expect to see some sort of a big jack, and you're not really seeing much action in some of the oils. They're trying to come up off their lows, like Silica here is moving up, Silica Holdings. I always keep an eye on EOG, Continental Resources. These are trying to come up. So, but there is hope that there's something going to occur here that will help out these beleaguered oil stocks. But they're so far down in their patterns. I think mostly what you're going to get, and you can see spikes in volume, say in Continental Resources, along the lows, and so it's been getting these little pocket pivots all the way along the low, but not going anywhere. Now we're getting something a little bit more concerted here up to the 50-day moving average. And I guess you could say this could, if you got big volume today higher than this day 2 days ago, then this would qualify as a pocket pivot if anybody wants to try and bottom fish in oil stocks. But in this case, I think a pullback into the 50-day would be a preferred entry. You'd be chasing it here. And if nothing occurs as a result of any of these meetings, or no agreement is forthcoming in terms of cutting production, then they're all going back down. So the bigger issue, I think, lies with some of the banks. I've been tracking things like Wells Fargo, JP Morgan, Citigroup, Bank of America. They're all hanging out in these little bear flags, and they're up and down within the patterns. But if the price of oil remains down here, and JP Morgan the other day came out and said that they were raising their loan loss reserves by $500 million, and if the price of oil stayed around $25 over the next 18 months, they would have to raise another $1.5 billion. So when you're wondering where forced selling comes from, you hear me use that term a lot, forced selling, that's what it is. When institutions who have exposure to areas where there may be some issues like oil industry loans, or there's also the new the HELOC, impending HELOC crisis. You know what a HELOC is, a home equity line of credit. And back in 2008, 2007, all that whole period during the real estate boom, a lot of people took out big home equity lines of credit, and a lot of these convert to regular mortgages. They're interest only until they convert to a regular mortgage if they're not paid off. Now, if you went and had a $300,000 house, suddenly it's worth $1 million. You take out a $600,000 line of credit, and the house goes back to what it was worth before the boom. Now you're deep underwater on the HELOC, and if that converts to a mortgage, you're going to be even deeper underwater, and your payments are going to be far more than you can afford. So there's a lot of these out, and some of the banks that have a lot of them on their books are Wells Fargo, Bank of America, of course. U.S. Bank is probably not as bad, but you can see it's doing the same thing. You notice how they chop around in here and don't really go anywhere. But I'm watching some of these because it reminds me of 2008 and the breakdown we saw in financials. And when you look at some of these, there's still a long ways for them to go if we did have some issues. But they're trying to undercutting these lows here on the weekly charts. They're trying to rally, so I'm watching these things as they rally. They may become shortable somewhere in here. I don't know if you could draw a trend line along these tops. Maybe that's where this one runs into trouble. Maybe it reverses right here at the 20-day line today. So, and you can look at any of these, but I think there is a crisis coming, and who knows if it's going to come next week or next month or next year. But a lot of these HELOCs are going to convert to regular mortgages sometime in 2016 and 2017. So that's something to keep an eye on. And that's the second wave of the original financial crisis. So I'd be watching some of these banks as potential shorts. As far as a long side goes, it's a junk off the bottom rally. So, you know, when in Rome, do as the Romans. And what I try and do is I'll buy some stocks on the basis of potential pops off their lows. I have a list of stocks I refer to as my long shots, and what they are mostly are beaten down names that are setting up in a sort of a Wyckofffian sort of mode. Like, let me give you an example. If you see something like a Tesla here, which has undercut all its lows in the pattern, it's even, let me see if I can make this a little more, here we go. Yeah, you've undercut all these lows, and now you're rallying back into the 10-week line. Now, my view is it gets to the 10-week line or gets close, 50-day or the 10-week on the weekly. So either or, it becomes a short again. But in the meantime, understanding how a lot of these play out on the short side, in other words, the rallies that can occur within what's an overall bearish pattern, and studying these over the years, I figured out ways that I can try and buy into some of these moves and play them to the upside for a period of time. But those are the best trades in this market. And you'll see that in names like Tesla, obviously. Netflix has been coming up, although, you know, that's starting to look like it might be a short. You're coming into this area of congestion along here, and so it may get there before it hits the 50-day, but you're very close to the 10-week. And you see that I'm talking about this area of congestion here, the underside of this prior failed base. So it could run into trouble. So that's one to keep an eye on. But you'll notice all of these rallies, while they're playable in the short term, as the market bounces, you can get decent long trades out of them. But you know, they're good for maybe 5% at most. If you get lucky, maybe 10%. But for the most part, they're trades, and you understand. Take them for what they are. You understand what they are. You don't think you're getting long for a big upside trend, because I don't think there's any real uptrend developing. If you look at where the markets are at right now, I got to keep both eyes, or my eyes actually, one eye on the short side and one eye on the long side as I'm watching the market rally, because I might want to play some of these rallies. You know, First Solar, I thought that was a short the other day as it was rallying here. Then I figured out, okay, this thing's pushing through this resistance, go long, and it's good for a couple of $3 on the upside. Then I'll flip and go short. Facebook, same thing. Find support at the 50-day line on Wednesday. And I was short the stock, and I saw it come down in here, and as soon as it turned, there was a 620 buy signal, so that causes you to cover the position. And then I decided, since it's holding support and we're getting a reversal off the lows and the indexes, go long the stock, and it goes up for 3 days. I think it's running out of gas here. I'm actually short an initial position here around 109 or so near the highs. So my thinking is you're coming right up to the breakout point, which is about 110, 109, somewhere in there. I mean, you can see it right here. You see this confluence of highs right at the 108 level, and it got just past that yesterday and just a little bit beyond that now. And then these highs here are around the 110, 111, well, 110.52 I think is the high here, roughly 110.82. So you're getting into an area where after a failed breakout attempt, so what this is doing is playing out as a possible late stage failed breakout. So I'm going to continue to play it on that basis. Now, if I understand that these things can rally after the first breakdown, which filled this gap and then turns back to the upside, then I can try and play it on the upside. And I've actually been going back and forth with Facebook. You can see it just chopping around for 2-3 points back and forth using my 620 intraday chart. But I think here you're vulnerable to a failure, so I'll put a little bit out and see what happens. If it gets through 110, maybe I'm gone. I'm up on the position right now, so maybe if it just pushes back to getting me underwater, so I'm slightly underwater, I may just cover it and see about revisiting it if and when it does actually roll over. Someone's asking about some stocks real quick, but what I wanted to talk about was, okay, as these stocks are rallying, they're rallying with the market, and you can see the NASDAQ is coming up to these highs from, I guess this is the beginning of February into January. and the 50-day line. So you're approaching an area where if you're chopping back and forth in a bear flag, and I'm going to assume that this is going to chop back and forth more than it's going to drift up to the upside for now, at least, until I were to see some confirmation through the 50-day. But I'm going to assume that you're in a range until proven otherwise. And so if I'm going to short something, I'm shorting it as I'm watching the indexes and making sure that this doesn't break out. If it breaks out, I'll just back away from the short side and cover and go away and wait for it to fail. But you're at a point where it could start to fail. So if you want to participate on the short side, you have to be testing the short side. You can't get lucky unless you put yourself in a position to be lucky. Now, it's a fluid situation because they might push you out of a short if the market keeps going. But it's feeling a little tired, and my general thinking is that the market has been subject to these waves of forced selling because of what's happening in the global economy. You've had China selling off the other night, what was that, Dr. Like 6.5% or something based on liquidity fears, and then the next day the Chinese government comes on and says, oh, we're going to take measures to shore up liquidity, blah, blah, blah. You've got the oil industry debt issue that's plaguing a lot of these financials, and the action in these financials and the XLF definitely shows you there's a problem. And then you have things like the HELOCs coming due in 2016. I think the first wave is in June. So there's these liquidity issues, and so liquidity issues cause institutions to raise liquidity. So in other words, you see J.P. Morgan raising their loan loss reserves. So they have to dump assets to do that. What are they going to dump? Well, what's the easiest thing to sell in our markets? Art? No. Cars, real estate, not so much. But stocks, you can unload those instantly. So that's what gets the nod when they start selling stuff to raise liquidity. So you have these bouts of forced selling. And then what happens, and what I've noticed, and this is where the ugly duckling theory comes into play. If you consider that the markets these days are mostly driven by rushes of liquidity, and the Fed says they're going to taper and the market tanks. The Fed says they're going to keep rates low, the market rallies. So it's all about which way the liquidity is sloshing at any given point, or anticipating the movements in by the Fed in terms of cutting off the supply of liquidity or not. And so that's what drives the market. And so you get these bouts of forced selling, and then they stop. Once J.P. Morgan has sold their $500 million that they're going to raise their loan loss reserves by, for right now at least, they're done. So they're done selling, they finish, and the market will suddenly, it's down 300 points, all of a sudden, zoom, it starts rallying to the upside. And you get a vacuum rally based on a lack of forced selling, or the forced selling taking place and then finishing. And so I think while the market's vulnerable to these vacuum rallies, it's also vulnerable to new waves of forced selling, because I don't think we're out of the woods in terms of the overall liquidity issues that face the global economy. So that's my big picture thesis. But it's why you'll see these rallies. And if you're short and you're not using some way, like a 620 chart, some way of telling you to get the hell out of the way and cover and take your profit, assuming you have one, before the thing jacks up your nose, you're going to get hurt. So you really have to be guarding against this when you're short. And nothing makes me more nervous than when I'm making money on the short side, because I've seen them turn this market so fast they take it away from you just as quickly as you made it. So you have to be on guard against that. And the same thing goes for the long side. We could have another wave of forced selling hit the market out of the blue. You wake up one day, the futures are down 150 on the NASDAQ, and you don't know what hit you. So that's really go ahead, Dr. Ken.
Just what you said is it speaks so true to the VIX volatility model, because the signal before the current one today, there was a 15.5% profit in UVXY from its buy signal, and that happened in 2 days. And we sent out a note, when the signal eventually hit a fail-safe, which was pretty much closing your position out flat. We said that hopefully some of you have taken our advice, because we've mentioned this I think 4 or 5 times now in respect to the VIX volatility model, that when you do have these quick profits, and they tend to be north of 15%, they tend to be 15% all the way up to I think on the high side it's like 25%, and that it happens very quickly, fiercely fast, and you have to be on your toes. Maybe just off the top of my head on the current signal, maybe you put in a, not a sell limit. I don't believe in buy, stop, sell, stops, or limits or anything like that. But put in your head, okay, here's where I bought, say you're buying VXX. Here's where I bought VXX. This is where the model went to a buy signal on VXX, and here is my 7.5% target. And if it hits that, then maybe I have the high-class problem of figuring out what to do with my position. Maybe I want to sell part of it at that point. Because that 7.5% in VXX is going to be 15% in something like UVXY. And, again, this is a very challenging market, so you have quick profits like that. And this has happened a number of times with the fixed model. You take it. You got to take it. Otherwise, as we saw with the prior signal, your 15% in UVXY vanishes. It vanishes in a day, as it did.
Yeah, so you got to be nimble in this environment, whether you're going to be long or short. And I don't think you have a long trend to play. I think you basically just have a lot of chop and junk off the bottom type rallies that you can try and play on the long side. And if you're good at it, and I know some people who are pretty good at it, I'd like to think I'm reasonably good at it. Maybe I'm a legend in my own mind, but it's possible to make some money if you can see them. And because I've studied the short side so extensively, I see a lot of these things, pushing up. Palo Alto Network's another one. You can see this. It sort of has this low and then a retest. That's a Wyckofian sort of retest. It holds and now it jacks to the upside. But now, see, this becomes a short at the 50-day moving average. Salesforce is another junk off the bottom type move. You could kind of see this one coming too. But now you're right at the 50-day. I've actually been hitting this over the past few days, but it breaks down. I cover it on the 620 signal that I'm using, usually a MACD stretch or just a turn on the moving averages. But this probably will eventually fail. Some other stocks, somebody's asking about AIG. Yeah, this is already way down in its pattern. So if you're going to assume that it's shortable here, then what you're going to assume is that it's either going to continue to follow the 10-day or the 20-day, because that's what it's been doing. You notice it does when it jacks on these brief jacks here and here. Let me pull out my pen here so you guys can see it. Here, I don't like this color. How do I get a different color? Choose pen color. That's what I like. I went, let's see. Let's use plain old black. So here, you see a jack in the 20 in here. So you could assume that if it's going to, most of the time it holds a 10-day. So if you wanted to short it here, you'd short it here, use the 10-day line or the high of today as your stop. A much juicier spot to short it based on the theory that it will continue to hold the 20-day line on the downside would be at the 20-day, but you may not get that chance. So I would basically say this is kind of down there. I kind of like, I've been putting out a position on WFC, Wells Fargo, and it's starting to come in now. So it's been blipping up today, beep, 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 just hitting it. Got 7,500 shares now, I think, yeah. And we'll see how this thing goes. But I think some of these other, what I would do is look at the banks and the financial institutions that are most vulnerable to trouble in the oil patch, or with some of the second wave of the mortgage crisis, which I think is coming. So that's what I'd be focusing on. Bank of America, maybe, and they're all in these bear flags, but Wells Fargo is in a better bear flag, better position. JP Morgan possibly as well, and you see that it's similar to Wells Fargo. It's sitting around its 20-day, but this is just a bear flag as I see it. You have this shakeout, and it turns back to the upside. It looks like maybe it could be a shakeout-plus-three, which would be 57, 57.50, something like that. It gets through that, but it doesn't really quite cut it. On the weekly chart, you can see here, though, you're coming into these lows. So this is an area of resistance overhead. So I'd be watching some of these as shorts. AIG, though, if these all come down, the XLF blows up, yeah, they're all going to blow up. This looks like a short here using the highs of the range or the highs of today as a stop, yeah. So you can see it. This is like a pod. Big pod, it fails. Boom. Now you get the rally back up into the moving average confluence. You also have a black cross. You can see the 50-day moving average has crossed below the 10-week moving average has crossed below the 40-week, which coincides with the 50-day not quite crossing the 200-day just yet, but it probably is going to. Market's flattening out. The Dow's up 0.07, 0.00. Now it's red, heading down. I'm actually short today. I'm short Netflix, Facebook. Getting this WFC out, it's starting to come in and it's starting to love me. Starbucks is another one I'm short here. Similar. You can see this is also similar to the TXN, because you guys know how I view moving averages not as lines, lines in the sand and hard lines, absolute lines or whatever. They're fuzzy zones. They're quantum zones, and so you can slide past them. But you see Starbucks reversing. I'm short that at about 58.80, so I'm getting a little bit of love here. But you can go through a short sale list, and I think I've showed you guys a lot of stuff on my short sale list that may be in shortable position. Let's run through some stuff. Here you got Baidu, hits the 200-day moving average. Boom, there you go. Shorted here, use the 200-day moving average as your stop. Splunk is another turkey jacking today on earnings, but what does it do? It comes right up into this little area of congestion right here, and it reverses. And that, getting close to the 10-week, getting close to the 50-day, but you could use a 620 chart this morning to get short this turkey. So it's starting to look a little bit grim here. Give me 1 second. Just putting out a little CRM. I covered that earlier. It came down like $1. I'm very fluid with these things. I'm back and forth all day, so it's a lot of busy work. I mean, I like making money on the short side, and some of the fastest profits I've made outside of the last 3 months of 1999, excuse me, has been on the short sides. But it's a lot of work, and anybody who's been doing it, you know what I'm talking about. And you're back and forth. I'm shorting, I'm covering, I'm reshorting, I'm covering, I'm reshorting, and just going back and forth on these things. Mainly because I want to keep myself from getting my head ripped off. So I've learned over the years that the biggest danger on the short side is getting your head ripped off, sitting there as they're jacking things. And I did that in April of 2009 when I was heavy short financials and they turned everything, and I just sat there and they nailed me on that. So that's something I learned from, and I guard against it now, and I have a number of mechanisms to do that. The main one being the 620 chart. Somebody's pointing out, okay, but anyways, you can see you had a sell signal. Now you get this little blip. But the price movement is contra to the cross. So to me, I think you're going to roll over again. So since I covered down low, I'm going to hit it here. I just hit it at 69. 69 on the nose. I won't make any comments about the number, but BOKF. What is BOKF? Bach Financial. They have exposure to oil. Yeah, a number of them do. JP Morgan does. I think Wells Fargo does. Citigroup does. Bank of America. They all do. These bankers, they never saw a loan that they didn't like to write. So, I mean, how many of you guys, if you have any money, the banks are all over you sending you stuff they want you to borrow money all the time. We get, Dr. K and I get these envelopes from our credit cards, our business credit cards at the office. And they have checks in them that, a sheet, you've seen those, right, Dr. K? A sheet of checks, start using $5,000, $10,000, APR, do it now before we start charging you interest and all this other crap. So everybody wants a loan. You might say, these bankers with interest rates so low, they're just writing loans, and I don't really understand it. But they're all in trouble. This is another one. Bear flag, looks like crap, ready to blow. Somebody's saying EA. Oh, a question that I can slam somebody on. Somebody says, short if market reverses. No, I would say short if the moon is in the 7th house and Jupiter aligns with Mars. What I would do here, just look at the stock. What's it doing? It's stalling out at the 50-day. Do you have a trade here? Yes. It's at the 50-day. You can use a high of the day or the 50-day as your stop and put it out here. Now, it might keep going to the 200-day, so that's why you put your stop on there. But yeah, it's at a shortable position. And you can look at this as well. I guess my whole point is here, you shouldn't have to ask me that question unless you're new, in which case you can be forgiven. But you're seeing it. You're right into this underside of this base, and you have the stock sliding just past the 10-week, but it's stopping at the 50-day. Where did my volume go? This happens every once in a while. I noticed that E-signal does some screwy things, so I'm just going to put a new one on. There you go, and you're wedging. So, all right, so let's do this. Here's how you do it. All right, I'm seeing bid 64.45. I'm going to short 2,500 shares just for a starter. So there, you did it. And did the market roll over? I don't know. It's starting to roll over. But all I know is this. The stock has been on my short sale watch list for a while. I've been waiting for a rally to the 50-day. And there it is. So it's in position. I'm going to hit it. What's my stop? Well, we'll use the high of the day, which is roughly 65 and change, 65.20, let's make it. So 64.50 to 65.20, what's my risk? A little over 1%. I can handle that, okay? So there you go. That's how you short. I just did it for you. And sometimes you don't even have to wait for the market to roll over. You can hit them at their position. So what I tell people to do is when you get into this position with the market chopping around the way it is, fixate and focus less on what the indexes are doing and just watch what the stocks are doing. Because believe it or not, even on a day when the market's getting hammered, some stocks might actually be flashing viable setups. They're sitting at a low risk spot where you can buy them. And one of those, for example, the other day, whoops, I don't want to use that chart, I want to use this one. One of those was Facebook. You know, it's coming down, but even as I'm shorted, I can see it's coming to the 50-day. So what am I doing? I'm watching for a reversal off the 50-day. If I get a 620 buy signal, then I'll flip out of the short and go long and then try to play the bounce. And that's all happening while the market's down. So you get a sense in that I'm not focusing so much on what the market's doing. I'm watching what the stocks are doing. And what I've noticed when I'm short and when I'm long, just doing that keeps you out of trouble. And keeps you in the right position. A lot of times you're moving on something before the market confirms weakness or whatever. So everybody pile onto the EA now, okay? So if you give me a buck on it, I'm short now at 64.44.2. So it comes down a buck, I'll be able to buy my lunch today. Anyways, let's see. PANW looks like, I would say it's not a BGU because it's not coming out of a constructive position, right, Dr. K?
Yeah, that's exactly right.
Yeah, it was a short today at the 50-day line.
Volume leading up to that point.
Yeah, so it's not a constructive position, so it's not a buyable gap up. So understand what a buyable gap up is. It's just a gap up. But yeah, it was short at the 50-day line, which coincides, and you can look at it in terms of the moving averages. You can also look at where overhead congestion or resistance lies. And I think it's pretty clear here that just getting past the 10-week brings you up into this area of congestion, and so that's overhead supply. And it reverses. You know, same thing with this EA. So that can be our short for the day, but since I put that one out there, it's probably not going to work now. But that's doing the same thing. So you're seeing all of these stocks coming up into areas of potential resistance. So what does that tell me? That tells me maybe this rally is going to give way here. Now here's Nike, okay? Now this is you consider this sort of a bizarre failure, but it's rallying back up to the highs here. Notice how it goes well past the 50-day. And if you tried shorting in here, which I did, but I covered very quickly, and a lot of times during the day you can tell pretty quickly whether you're going to make money on anything on the short side, because it'll be easy, it'll work. And that's the number one way that I can tell if my short positions are going to work for me. They roll over relatively quickly. So Starbucks, good example this morning. Facebook, sort of, yeah. Wells Fargo come in a little bit, and this EA now is bid 64.46. So it's hanging up there. But you can see here, you're up to this level of this prior high, which has served as intraday resistance, at least for now, but it's also underneath these lows. So as you're going through your short watch list, you can see what the stocks are doing and where they are. And as they approach areas where there's potential resistance, you may see the same thing occur in the market. But you notice how Nike continues going past the 50-day. So you can't use the 50-day as some hard line that you're going to short at and it's going to work and expect it to work. It can slide past you if the general market continues higher, at which point you're watching for another spot. So, you know, do you really need to know if the market's going higher if you shorted Nike at the 50-day? No. All you need to know is that if it pushes you out of your position by going further up through the 50-day moving average, you're gone. And that's all you need to watch. You don't need to watch what the general market's doing. So hopefully IBD now talks about breakaway gaps. Sounds suspiciously like your BGUs. Yeah, but you notice they don't give you any absolute parameters or method for dealing with them. You know, you can buy a breakaway gap. Well, exactly how do you do it? So if a stock's up 20% in one day and let's say it fails, how do you get out? They don't tell you that. But I think this is one of the big failings of IBD and the O'Neill organization. And I know I've heard through the grapevine they laid off about 40% of their staff at the paper the other day. And there's all kinds of other fun stuff that I'm not going to talk about. I'll let them announce it. But they're paring back in a big way because they're not flexible and they don't have that edge anymore. If you think about it, if Dr. K and I were still working at O'Neill and Dr. K came up with the viable gap up concept and the pocket pivot while I was coming up with the punch bowl of death, the pod formation, and how to short that, they would have probably taken that as stuff they can use. But because we don't work there, we're now personas non gratas. I guess that's how you would say it in Latin. Help me out on that one, Dr. K. And so, they've lost that edge, and they're closed-minded. And in my view, you become that closed-minded, that rigid, and basically that stupid, you deserve what you get. So, okay. The EA, I've shorted EA before, and it never wants to go down when I short it. So, don't anyone short it because you're probably not going to make any money on that one. And it'll be the only stock that holds up if the market tanks. Somebody says, correct, a gap up is extremely bullish provided the stock has strong fundamentals. Yeah, you just need to have a precise way of handling it if it doesn't work. I mean, we know that the best viable gap ups generally occur coming out of an early stage base, okay, and they generally occur in a stock that has a very compelling fundamental theme or business. We saw it in Tesla. We've seen it in names like FireEye. I think last year had a big gap up out of its first base. Let me take a look at that real quick. This will give you a sense of what I'm talking about. Yeah, there it is. See, there's the Bible gap up right there. And you have to have a way of knowing how to handle that. So if you bought that one early in the day, then you were doing pretty well, and that one worked. Okay, but just to say, yes, you can buy them without telling you exactly how you buy them, where you set your stop. Okay, whatever. Let's see. Let's keep going through some of these things. Software Toolworks. Skyworks Solutions. I don't know why I did that. That's another one that's in a slow bear flag. Is that a shortable position? Yeah, it could be. It's kind of down there. I like some of the fresher stuff. I actually think Facebook would be one of the fresher ones to look at. Give me 1 second here, everybody. Looks like one of my programs logged me off. There we go. We're back. Okay. McDonald's, these are... Notice how it's failing at the 50-day. I think this is probably a short using the 50-day line. I think we have these out as short sale reports or something like that. But you see, you have this initial failure and then a little rally, and you notice how it gets hit with a lot of volume around the 50-day. So that looks like a short, and I like these fresher ones rather than these things that are deep down and dirty. So let's see. Dr. K, how do you trade the VIX? Do you just use your signals? I guess he does. Do you, Dr. K?
Yeah, when the model has a signal change, then I act accordingly in my own account. And I mean, as far as position sizing, that's up to you. I mean, that comes right down to your own risk tolerance, personal risk tolerance levels. I have a lot of confidence in the model because I have been working with it. It's been a work in progress for a number of years. It started out as a day trading system that does work, but it doesn't work for my trading personality. I just don't like being glued to the screen the entire day, if you kind of have to be. I would love to computerize it, but it's not a black box. It requires my chart eye to be able to decipher whether a signal is a real buy or sell signal on an intraday basis. My brain doesn't like that. It never has liked that kind of trading. So that said, it evolved last year because of the trendless markets into what it is today. That's why we went to beta on the model at the end of August of last year, because there was now enough testing that I'd done that had shown that this risk reward is really compatible with anything I've ever done, plus compatible with my trading personality, and is doable for the website. So So far, I've been very pleased with the results. As I said, it's garnered a few 15% plus gains in a very short amount of time. If you were using a 2x ETF like UBXY or TBIX. And those are not reflected in the performance tables. The performance tables are strictly on the major buy and sell signals of the model. And I have enough confidence that just those signals alone are going to prove out. But what's nice is you get this extra boost by taking profits early when you have them. And this has happened even in the testing phase of the model that's not up on the website. The model does have a tendency to do that, to make quick gains on buy signals. In other words, when the market's hitting lower, it tends to head lower, taking the trapdoor down. And therefore, you can be sitting with very fast gains in a matter of a day or two or less. Therefore, so far it's working as expected, and this is going to probably be a continuation of the volatility we've seen, and the model tends to thrive on volatility. Volatile environments are its friend. So I don't see us going back into one of these lackluster uptrends that we saw in 2013 that were motivated by QE, a fierce amount of QE put forth by the Fed, which created very shallow floors. And as we all know, the S&P I don't think corrected even more than 5% for I think one of its longest stretches of like 18 months. Therefore, I think those days are behind us, and I think that therefore bodes well for volatility, more enhanced volatility going forward. Yeah, I think you need to turn on your mic.
Yeah, someone's asking about the airlines and oil up, HA and JBlue, are these overbought or something else going on? Well, these have been decent stocks to be long. So, you know, HA has been, I talked about buying this one around here a few weeks ago, and that's been the leader in the group. But the others are all coming back. But, you know, again, they're just rallying up off the lows in their pattern. So I don't really see this as overbought, underbought, undersold, oversold, whatever. It's just they're coming up off their lows. They probably are going to reach a shortable position, but HA is the exception in that it's broken out. Now, what you might watch for maybe is a breakout failure. Okay, let's see. Market went down. Now it's up a little bit on the Dow. So I'm making money everywhere except this Wells Fargo is pushing again. It came in and it's pushing back up. We'll see what happens there. But you're seeing a number of these stocks I'm showing you are in areas where they might be shorted. Look at Ulta. There's another one. We looked at Google, I think, a little while ago. Google is at the 10-week line, so that's in a shortable position probably. Amazon had a pocket pivot along right here, right along the 200-day line. So I don't know. I've been thinking this might head to the 50-day, but it would have to break the 20-day to be shortable again, I think. You look at most of these. Apple is in a bear flag. It's at the highs of the bear flag, so this might be shortable. Looking for it to break out. You know, otherwise, if it got to the 50-day line, which is at 99.70, it might be a little juicier on the short side. We looked at some of these chip stocks. Notice this one has slid past the 200-day, but you can see this is big wedging rally. You see the volume is declining here, and now you're at this area. You're up into this area of congestion around the 44 level, and it's the highs of this little range, and it's reversing. That might be a spot to short the stock. How many of you guys are short EA now? Did anybody short CRM at 69? You have 30 cents on it. That'll buy you a Big Mac. Let's see. What else? Let's look at Priceline. Price line hanging along the 200-day. Almost looks like it wants to go higher. If it reverses down through the 200-day, it probably becomes a short again. Microsoft, whoops, let me get the right symbol in there. Reverses at the 50-day. Okay, so that was a short this morning if you're watching it. Baidu we looked at. Facebook is coming in. It's now down a penny. Netflix I think is probably a short in here. Like I said, it's coming into this area. It could go a little higher, but I'm willing to test a small position out here and see what happens. Let's see on the 620. It's kind of hovering. See that? If you had a decisive break, then that would be your signal. Right now it's kind of telling you could get away with trying to short it here, maybe use the highs of this range, which is around 96.20 or so, 96.26, somewhere in there. So say 96.30, okay, which is all of 40 cents from where it's trading right now. And with the idea that it's going to break this. So anyways, no guarantees that'll work, but that's something to potentially look at. That's all the big stocks. Let's look at cruising down my list here. CCL, Carnival Cruise Lines or Carnival Corp. That's probably in an area where it can be shorted. Notice how it rallies all the way back up to the 10-week line. So remember, I've gone over this many times. You always want to be watching the 10-week and the 50-day moving averages on both the weekly and the daily charts on your short sale targets, because they may get to the 10-week and reverse before they get to the 50-day or the 200-day. So that's something to keep an eye on. But are you guys getting a sense of what we're looking at as we look through all these charts? We're seeing a lot of stocks that have rallied right into logical areas of resistance. So you might conclude then that we're in a spot where we might see a potential downside inflection. So on that basis, I'm willing to test out some shorts. And right now I've got 6 short positions out. None of them are huge. Well, Facebook is getting huge now. It's about 50%. So that's kind of big. The others are running about 10, 15, something like that. Don't quote me on that. I have to check that, see where I'm at with them. But I'm willing to take some shots here. So as stocks are set up, I'll hit them. Boom, boom, boom. And I'm not really waiting for the market to roll over. A lot of times if you do, you're kind of late. I'm willing to test them as soon as I can establish a point where I can set my stop. And it's fairly tight. So like I was just talking about with Netflix, if I'm thinking about this one, here, if I wanted to go short it here, what I'm looking for is confirmation would be a 620 sell. Forget what the market's doing. But near term, where's my intraday resistance? Around 96.20, 96.30. So if it got up to that, I might cover and then wait and see if it flutters again and rolls over, then come back after it again. So, there's a lot of ways to skin a cat here, and sometimes you have to skin the cat 2 or 3 times before you get the skin off, if that makes any sense. Any other brilliant questions? None. Okay. Let's see. RCL, another one. Let's take a look at this. Hanging at the 20-day. So it's a lot weaker than CCL. I think they're being sued. Wasn't there some news about them being sued today by people who were on one of their nightmare cruises? You'll never get me to go on a cruise. I know people have told me they're fun and great, but I don't see the joy in or the fun in sitting on a stupid boat, looking at an artificial environment that's floating on a big ocean. I'd rather just go visit places. I like the Dr. K World Tour that's going on right now. Is more my sort of. Where are you headed now? You're in Argentina right now, Dr. K. Where you're headed? Where? New Zealand next?
Yeah, we've been skating the Southern Hemisphere for the last year, and so now we're in Buenos Aires, and we're going to head to Auckland, which is New Zealand. And never been, but that's where they filmed The Hobbit and a number of other glorious films. So it
Cool.
should be a pretty cool adventure. And then we'll see from there. But Northern Hemisphere is turning warm by then, so we might head up to Euroland and see what all the mayhem is up there.
Cool. Well, if you can spare us the time, you might stop in California for dinner or something. In any case, let's continue. LinkedIn. Maybe on the way back. This might be getting to a short spot. If you think about this as being a massive shortable gap down, and this kind of washes everyone out short term, you get a little more downside, and now it's drifting around, but the volume is very light. And you could use a high here as like 128, I believe, and change. As your stop, you're sitting at 120. Maybe if it got to the 20-day, if that kept dipping lower, that might give you a better spot. But you could always hit it any point along here thinking it's going to short, or it's going to fail rather, with the market. And on any day, if I wanted to short it, I might come in and use the high of the day as my stop. So today's high would be the 120.97 level. You're trading, what are you trading at right now? 120. So you're kind of like right there. And you can use that as a quick stop. If it doesn't work, you're just gone. Boom. See ya. And that's a good way to work these if you want to. Of course, a lot of times it means you're shorting and then covering, shorting, covering. You're doing that every day. But for that reason, you don't want to use a full-priced broker, okay? Anyways, let's see. Where are we at now? I noticed the EA's coming in. You guys need to short more of that. You got to knock it down. I'm making a whole dime and a half on it. So let's see. Avago, that's another one. I'm trying to find where all these are. Yeah, that's another one running into a potential area of resistance. You might watch that. Volume's light. And I think there's a number of these. What's the other big one? NXPI, yeah. Yeah, that's kind of in no man's land. So, but you can see some of them are in spots where they could be shortable, and so you can take shots. And I think you're definitely seeing, and I think I've given you several actionable ideas so far today. You can see they're all there. They're right there. So you've got to take your shots. Either that, or I think you're in cash. If I was long, and I was long some things like Facebook, and I was long First Solar for a little while yesterday, but flipped out of that and went short that this morning and covered. I'm out of that one already, mainly because there's so many other things that look so juicy, and that's one of the stronger stocks, because if you look at this thing, it's actually a big pocket pivot breakout, but it runs into the highs here and it reverses, so maybe it pulls in. Does this have further potential? Only if the market goes higher on the upside. So we'll see what happens. So somebody says, in a market like this, do you typically have short positions for a few days only? I may have them for a few minutes only. Like I've been telling you several times so far in this webinar, I can be in and out of these things all day long. Putting them out in the morning, they don't work. Come back after them later in the afternoon. I might put them out on one day, and it goes to the high of the day, and it stops me out very quickly, and I wait for the next day and come back and short it. And a lot of times I try to work stocks continuously on the short side. So in other words, even as something is trending lower, so I mean, an example might be if I was shorting First Solar here, it would come down and then I would cover, and then the next morning if it rallied, I'd short it again and I would cover, short it again, cover. This is like an ideal situation because it rallies slightly every day and opens slightly up from the prior close. You can kind of see that on this chart because it has the opening tick and the closing tick. And that would be ideal, and that's usually what I do. I usually work these things very rapidly, and the brokers love it. I know I'm one of the top 3 accounts at Schwab, the entire Schwab system, for trading size and trading frequency. I may be in first place, but my 1099 is like 4 feet high, so and they have to send it to me. A big truck comes to deliver it to me, so I'm pretty active when it comes to shorting. So I don't just take positions and sit for a few days or and there's no formula. It depends on what they do and how much of a cushion I get. If I short something and I have a big cushion overnight, or on that day I get a big cushion, I may hold some of it overnight. So there's no rules. I know you've probably been trained by outfits like IBD to think that investing is as easy as 1, 2, 3, and all you need is a few stupid rules to follow and you don't really have to think, but it's really not like that. So, and especially if you're going to short. Shorting takes a lot of work, and I think you get much better at it probably after you've screwed up in a big way a few times and have studied it for a long time. So, I've spent a lot of time doing it and studying it, so I think I've gotten better. And I don't really get hit too badly on the short side when I'm wrong. So, but I've learned. 2009 taught me a very valuable lesson as far as I'm concerned. Somebody says, any thoughts on SUNE as well as the future of solar? I think solar's screwed. How's that? SUNY's up because there are some companies suing them. And why would you be dumb enough to even think about this stock? It's a $2.40 stock. Wow. So, what does it mean? They were sued by somebody because they weren't going to be able to buy. I think it's Vivint Solar or something. And so the thing jacked. Yeah, everybody's, it's up 40% today. But come on, this is a piece of crap. And most of the solars look like crap. SunPower I thought maybe had some potential. This is like a short, Let's look at the weekly chart looks like a fractal head and shoulders here. You can see it on the daily. This thing looks like it wants to go lower. Short that. First Solar is the only one that looks good. Another one I've liked from a fundamental standpoint, but you can throw fundamentals out the window when the technicals don't do anything for you. And this one's also looking like it might be a short. But I would think that if the market can rally, maybe it has a shot because it does have some pretty compelling fundamentals. But, you know, the future of solar is it's based on subsidies, and I don't know, can governments continue to give things away for free forever? I don't think so. That's not to say I don't love solar, right, Dr. K? You love solar, don't you? I have a solar-powered beanie with a fan on it, so on hot days, the solar cell powers the fan and keeps me cool. So, you know, I think solar works best that way. And I was looking at a solar system for my rooftop, but what I'm interested in is something that would be off the grid so that when the electricity goes down, when the riots come in the next year or two, and all the infrastructure goes straight to hell, I want to be off the grid. And the solar panels that they will, in most cases, lease you. You don't really own them. They only work if the grid works, so that doesn't help me. So I'm looking at some of these battery packs, like things that Tesla's making, which you can actually get a better one from Panasonic, cheaper. Tesla's the fatty one, but those wall power packs that you, during the off hours, you can charge it up, and then you have electricity when everything goes down. So so that's my thought, Michael, on solar power. Forget it. And then, you know, Sunni, I mean, why are you looking at this? That's the one that I would want to know. That would be the main question. Anyways, it's 9 o'clock. The market's starting to roll over. We're making new lows. I gave you some things to short. Maybe you shorted. If you look at the EA now, we got 40 cents on it. That might pay for lunch. So we'll see what happens. But again, you guys get, I think today was valuable, and I'm glad we picked today to do the webinar rather than yesterday, because you got to a point where you're seeing a lot of the things that are at least on my short sale watch list running right into resistance, right into logical areas of resistance in their patterns, and they're all doing it at the same time. And since I pay attention to what the stocks are doing first and not so much the indexes, it's telling me time to go short. Anyways, we'll see what happens by the end of the day. For all we know, you know, the Fed comes out and announces QE 4, 5, and 6 all together, and the market turns and rallies 200 points. But it's that erratic at times. But anyways, no, I don't really monitor the tick or the put-call ratio. Maybe the put-call ratio. But other things, you know, actually, no, I'd have to go ahead, Dr. K. What do you watch?
Yeah, the put-to-call, I mean, over the last, you know, prior to QE, the put-to-call had some merit. And then after QE, it still had merit, not as much merit as before. But since the start of this year, the put-to-call has spiked a number of times, and the market continued lower. So it's almost
like it's hedging.
Selling pressure going on that it's invalidated this indicator that used to have some merit.
Yeah, or it just means that you're getting hedging from institutions who are buying puts. I've noticed the puts-call ratio sometimes spikes near index highs, and that seems to speak of somebody just buying a ton of puts to hedge. So now I wouldn't, you know, again, if you overload yourself with too much crap, and you know, there's 50 books that'll tell you need to look at this, and the other thing. The only thing I look at, and over years that I've learned to just rely on, is what the stocks are doing. So I can say it 100 times, and people will still ask me, do I use any other indicators? No, just watch the stocks and learn how to watch the stocks. That's all Livermore did. I don't even think Livermore had a put call. He just had the ticker tape there, and he's reading that. Learn to do that, and you won't need any indicators. Everything derives from the price volume action anyways, and sentiment can be wrong many times. So anyways, you guys, that's all we've got for today. Hopefully this was helpful, and we'll just see where things go from here. So anyways, we'll catch you next week. Have a great weekend.
So long, everyone.